The market does look good across the board with some very nice green, but we also notice some red patches of companies that are starting to struggle, and today's focus is on United Parcel Service. It is down a massive 15% and trading at a new 52-week low. Having said that, Wall Street and Seeking Alpha do give this a buy rating, and the yield will now be sitting around the 5% point. But it has struggled over the last year, down 28%, and over the last 10 years, and it is up only a measly 34%, massive underperformance of the S&P. Jumping straight into the reason why this company has suffered significantly today, but we can see they have slashed their Amazon exposure by no choice of their own, and that has ultimately hit their 2025 forecast, something that analysts did not want to see. Now, if we take a look and just read a little bit of the information, but we can in fact see the revenue now is going to be cut back as the deliveries for their largest customer, which has been Amazon, is going to be down. In fact, volumes are expected to be dropped by more than 50% over the second half of next year. And analysts, as we can clearly see, are surprised by this, as it's already during a difficult time for UPS, as in fact they have had a lot of weakness in their demand post-pandemic, very low profit in their shipments, and we can in fact see from sellers like Temu and Shein, and Amazon is quite a large customer of theirs. It does account for nearly 12% of their total revenue in 2023, and the volumes are anticipated to drop by around 50% in 18 months. That is really not a good sign, as we said, for this company. Although UPS, they do want to spin it in a positive light, and they are saying by carrying less freight for Amazon, this will eventually boost their revenue per piece. However, bear in mind, still less volume means less total sales right across the board. In terms of their numbers, how they performed and the expectations, well, for 2025, their revenue is anticipated to hit 89 billion. That is quite a way down from the market anticipation of 95 billion. But one thing that they have said is very positive. They've been increasing their margin, although not the greatest amount, 10.8%. It was previously reported at 9.8%. In terms of their actual earnings, well, for this latest quarter, they hit 25.3 billion, which was a marginal miss from the 25.42 the market wanted to see, but they did come above on the EPS, 2.75, quite a substantial beat as well, 2.53, as we can see, that is what the market wanted. So lots of information to take in from UPS, and we can have a very quick look at the company itself. In terms of what they expect for 2025, well, we do have here double-digit growth for the next 3 quarters, which is positive, although bear in mind, now this news of Amazon has come out reducing their volume by around 50% over the next 18 months. It could substantially hurt their figures moving forwards. And when we do look back, given they did just release Q4, which was a beat on the EPS, now out of the last 5 quarters, they have beaten 4 of them. That is an 80% track record. And if you're looking at the expectation over the next full year, it does give their forward PE a fairly low figure, around 15.31. And what we typically like to do, compare that against the sector median. It does sit lower, meaning right now you are getting a discount for this company, but also it's trading lower than their 5-year average. So in fact, UPS lower than the sector, lower than their 5-year average, and you can see this pretty much reflected in the vast majority of metrics. UPS, a company now trading at a discount. Question is, does it deserve the discount given this news, or is there an element of margin of safety that means we should be considering buying with a very attractive yield? And moving on to their growth, we can see the poorest grade obtainable at an F, year on year, negative 3%, well below the sector median of 4%, well below their 5-year average of 5%. Moving forwards, negative 2%, again below both the sector median and their average over the last 5 years. But one thing that is incredibly disappointing, and we don't expect to get better anytime soon, is the EPS anticipated 4.61% over the next 3 to 5 years, lower than both the 11.5 and the 8.9 of both comparatives respectively. So a lot to factor for this company. In terms of the profitability, it does come out a little better with an A+. Gross margin 22% below the sector, but pretty much in line with their 5-year average. Bottom line 6.25, pretty much in line with the sector median, not massively far off their 5-year average. But the reason why they do get a fairly positive result here is the cash they generate from operations, 9.2 billion, far superior than the 342 million of the sector, but it does also, bear in mind, come in lower than their 5-year average, maybe a trend we could see for the foreseeable future given this news. Now, we also just want to flag here, when we do look at the performance of UPS, again against others in the air freight and logistics department, we can see they haven't had the best of times over the last year, including dividends reinvested. They are down 25%, the worst performing. Over the last 5 years, up only 16%. Whilst it's not been a very good performance, we can see it's not the worst, so the industry as a whole, not that great. I mean, FedEx here up 97%, the best performing, but we have a lot in the middle that actually have performed fairly poorly. And over the last 10 years, 55% for this company specific isn't the greatest of return. You probably wouldn't want to see this from any investment over the next 10, but as always, past performance doesn't have any bearing on the future. In terms of institutions, we do sit around 60% ownership, around 8 billion of sales over the last year. We get a little bit more buying over the same time frame, but as we can see, like many stocks in quarter 4, institutions were selling 4 times as much as they were buying. Looking at the same but for insiders with ownership at 0.13%, we actually got some buying over the last year as well as some selling, but in the most recent period, so in 2025 alone, no movement. In Q4, the most recent data point we can see of movement, there was sales of just over $1 million. Now we'll see the latest sale was in fact by an insider on the 25th of November. You could argue that is a bit outdated, selling around 7,325 shares, netting them just over $1 million. But as we always say, this information we don't typically take as bearish, but information is there if you want. They sell for many reasons, personal and financial. Very quick deep dive into the underlying metrics of UPS, 69 score, so it does look to be safe in terms of the dividend. Credit rating A, that is strong. We'll cover these two valuations, but a very poor increase in the last year at 0.6%, well below inflation at 4%, but we will expect an increase over the next few days. In terms of what this means, a safe score, which was just reaffirmed in November, a dividend cut for United Parcel Service does look to be unlikely. In terms of the last recession, key metrics, how they performed, the 07-09, in fact, they maintained the dividend, didn't increase, didn't cut it. They had average growth sales at negative 12%, and they only marginally outperformed the S&P, negative 48 versus negative 55. In terms of dividend growth, already mentioned, very poor. Over both the last 5 and the last 20 years, they have been increasing at a double-digit rate, but I would be of the opinion that at least for the foreseeable future, we won't see anything too great, barely around the 4% point. They have also been increasing those dividends for the last 14 years consecutively, but paying a dividend for the last 55 without a reduction. Now, the first valuation model, remember we will run it through our own process and we don't look at this in isolation. The blue tunnel tells us the expected fair price. Right now, it sits below that. That is an indication, or in fact telling us it is severely undervalued. Remember though, we don't look at just one model. We then move on to dividend yield theory, telling us this company is undervalued as the current yield not only above the 5-year average of 3.48, but also the highest yield they have offered over the period. And on the forward PE, another undervaluation signal as the forward PE 13.2 sits below the 5-year average, and we already mentioned it does trade at a massive discount to the overall sector. In terms of the free cash flow payout, we want it below 60%. What we actually note over the last year on a trailing 12 month, it is in fact in triple digits. Bit of a worry, that means the management paid out more in dividends than they generated in free cash flow. We want to see the actual free cash flow fairly consistent and increasing over the longer term. Very inconsistent, although we are led to believe over the next 12 months we are expecting a fairly large increase. And then the sales growth, we want 3 to 7% on a consistent basis, at least 3 just to keep up in line with inflation. We get that for the large part, although bear in mind, over the last full year and on a trailing 12 month, we are seeing negative numbers, something to factor in, especially with this Amazon news. We should, however, highlight maybe not a massive amount, but they have been doing some levels of share buybacks, returning some levels here again of excess cash to investor pockets. If you want to see the ROIC, even though it has been decreasing over the last 10 years, still very strong, 20% in 2023, 18 on a trailing 12 month. And then we get to the margins, where ideally we want to see signs of operating efficiency, that is margins to increase. we don't actually see that. We see it pretty much straddle around the minimum levels we want to see year on year, and the same to be said when we do look at the free cash flow margin. In terms of the net debt to EBITDA, below 3 is what we want to see, 1.58 in 2023, there or thereabout over the next 12 months, and remember what you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. Not too bad, especially given the fact the free cash flow payout does look to be fairly high, and as we saw, the dividend safety level does sit at 69. Now, before we jump into the valuation, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning for free to your inbox, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January, information as well on the upside that Wall Street see over the next year, and we will be releasing the February copy in a matter of days. You'll also be able to gain access to a recently released copy of 43 stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to the intrinsic value, which comes to $130, an average of these three models. Now we can run into them very quickly. The first one, the multiples valuation. Companies in a similar sector and size, average P multiplied by the EPS of UPS, where we do get our first undervaluation signal. Bearing in mind, we're not looking at any of these in pure isolation. Then we have the dividend discount model, the most recent increase, as we can see here, below 1%. On average though, at 12, we've gone for 3% moving forwards, and that gives us another undervaluation signal. Then we have the DCF model with growth rate moving forwards at around 6%, and with a discount rate, we get the present value of the future free cash flows. This ultimately gives us the intrinsic price here, 127, again, 3 models all showing small undervaluation. Now we don't stop there, as we do apply a margin of safety at 10% just to start off, but what we can see at around $117, you are looking at the 10% MOS. Then we keep going till we get near that price, and right now for United Parcel Service we see 10 to 15%. Also bear in mind you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for UPS or any others. Wall Street themselves, this is prior to the announcement today, had a price target of $145, translating to 27% upside, but it is likely after this news they will be revising their price downwards, and our opinion is, one, this news is quite massive, it will impact their numbers moving forwards. The margin of safety right now isn't the greatest to consider a buy, even though the yield is around the 5% point, and we do, as we said, expect Wall Street themselves to bring down the price target quite substantially. Having said that, do give us your thoughts in the comments if you are buying or in fact looking to sell. And also, don't forget to sign up to the free weekly newsletter, grab those spreadsheets. Also, come and join us in the Patreon, where we do talk about our weekly buys and sells, and we have made some movements in the portfolio this week. And have a great day. We'll see you all on the next one.